welcome to this Edison interview between myself, Elliot Burstock at Edison Group, and Gervais Williams, Head of Equities at Premier Miton. Delighted to have Gervais on the platform today. We are going to discuss the outlook for global equities and how the Diverse Income Trust is positioned and what performance has been of late. But firstly, Gervais, thanks for coming onto the platform, and maybe let's kick off with a debate that has been going on for some time now, and it's about inflation, whether it being structural or transitory. Where do you sit on that debate, and how does that drive your positioning in the portfolio?
Yeah, hello, Elliot. Yeah, I mean, what's interesting about inflation, yes, it's been quite a spike. We've seen some very strong inflationary figures, but if anything, I think the bigger worries at the moment is that the economic sort of pickup is going to peak out a bit. We've seen China in particular entering a period of slowdown. I think those are structural problems rather than cyclical problems. In other words, I think the Chinese slowdown will be something which will be staying with us for many years. But alongside that, we've also had worries about the new variant, COVID variant, which will potentially also suppress activity and could lead to not just oil prices going down, but just generally the inflationary pressures becoming less pushy. So my assumption is actually that the inflationary peak we have at the moment will turn out to be somewhat transitory, in that within a quarter or two, inflation will be much, much lower.
Great. So I'm sensing a slightly more cautious maybe outlook for 2022, and we'll no doubt have some tapering by the government towards the latter part of next year. Is it fair to say you're seeing more cautious sort of overtones in the market at the moment?
Yes, I mean, I think, a lot of the mainstream stocks are priced to perfection, particularly in the US, for example. So I think valuations are very elevated, which is always a difficult place to start. Then when you overlay that with not just a slowdown in economic growth because of China, perhaps on global growth, but also worries about the cost of labor, which may be more, which may be a feature which becomes more pushy, not just because of inflation, but because actually wages are quite low as a percentage of GDP, of the GDP at the moment. So from that point of view, I think actually we've seen a change in sea change over the recent years, with specifically, we used to rely on long-term, long-distance supply routes for things like PPE, personal protection equipment and such like. What we found out during COVID was actually that when you needed it, you were in a queue. And that's going to be a feature which is changing the behavior of politicians. They want more local suppliers. That does involve extra staff. And I think there's a critical shortage of staff, not just in the UK, but across most of the Western economies. And I think that's going to push costs of goods up, and actually at a time when companies will be under margin pressure. It'll be quite a difficult period for 2022 and 2023.
Okay. And UK equities, we touched on there, that they've underperformed US equities for a significant amount of time. Maybe you could talk about some of the characteristics of the UK market being more income oriented and the sectors that drive the UK equity market. Do you see a sea change coming and a sort of reversal in those performance trends, and what do you think will drive that?
Yes, I mean, it's interesting, really. I think the last 30 years have been defined by, the valuations of all assets increasing, including specifically bonds, but also stocks and shares and such like. But alongside that, we've also seen, rapid growth, particularly driven by China. Well, if China's reaching a period of structural slowdown, and if we find that actually valuations can't rise much further because bond yields can only go down to zero, really, then we could find that the drivers of improvement are running out. During this last 30 years, really, in rising markets, you've wanted what's called high beta equities, the more volatile equities, the ones which tend to rise faster as markets rise. And these have often been growth companies, unicorns and such like. What you didn't want is a lot of UK equities. UK equities tend to have a lot of income. They tend to be slower growing. And if the market halves because they've got a big yield, they don't tend to come down so fast. So they tend to fluctuate less frequently. So the advantage has been with the US stock market the last 30 years. They've outperformed. The UK equity market's been a disadvantage. Going forward, I expect that to completely reverse. One of the advantages of having companies with strong balance sheets is that the margin pressure, they're less likely to go bust. But much, much, much bigger advantage is they can use that surplus cash, particularly when companies are under real margin pressure, such as private businesses. They can acquire those assets from the receiver, keep the staff at work, but most particularly make an abnormal cash return. And I think that's going to be a feature which is going to drive the outperformance of UK equities. Now, what people don't remember is that that's what used to happen back in the 60s and the 70s and even the early 80s. The UK stock market used to outperform the US stock market. I expect that to return, which will be quite a shock because most people aren't expecting.
Yeah, and I guess talking about a slightly more cautious outlook, one of the beauties of the diverse income trust is it employs a put option that you've used to good effect historically. Currently, Gervais, do you have a put option? How big is that put option at the moment? And I guess the question is, at what time do you decide to sell the put option?
Yes, I mean, the put option is a bit like stock market insurance, a bit like your car insurance. You don't like paying a premium, but if you don't have a crash, it's just fine. And that's the truth with the stock market. Stock market doesn't have a crash very often. And so we have had a put option in the diverse income trust for the last 4 or 5 years. And so we need to keep the cost right down. And to do that, you have to buy it at a time when people aren't worried about crashes. And you need to buy it at somewhat a sort of a protection which isn't just immediate, but somewhat if things get really bad. So we've had that in place. It's been costing about 1% per year, detracting from returns. Last year, of course, we did have a crash, and the put option was there, and the insurance didn't just come in and produce a kind of a softening of the a sort of cushion against poor performance, but we were able to take the profits, partly because the valuation of stock market insurance went very, very high. And that was the reason we sold it last year. So that brought in the fund, along with some takeovers, to 13 or 14% surplus cash right at the bottom of the stock market. We were able to buy stock market investments with good yields at a time when everyone else was selling them at very attractive entry prices. So that was a great advantage. Over the last 18 months, we haven't been able to have a put option. The cost has been too high until recently. About 6 or 8 weeks ago, we bought a new put option. It's not quite as cheap as it was last time. It's costing us about 1.3% per year for about 40%, 38 or 40% protection against the stock market crash. Clearly, we don't know if there's going to be a stock market crash, but it's nice to have it in there for an extreme rainy day. And that extends through to December 2022.
Okay, great. And the diverse income trust has outperformed over 1, 5, and 10 years. That's the UK equity income sector. Are you still excited about the opportunities that you're finding in the UK stock market? And perhaps maybe you could give a couple of examples of recent additions to the portfolio.
Yes, I mean, what's interesting about the UK stock market isn't so much just that it's a low beta market. It's less volatile, perhaps, than the many other stock markets because of that income requirement. But the other feature about the UK stock market is it's vibrant in terms of having a lot of small quoted companies on the AIM listings. And that gives the advantage for us to invest in a much wider range of companies. Some of them are younger and able to grow when the world's not growing. Some of them are in different sectors which aren't traditional for income, and therefore gives us a wider range of income sources and less reliance on the main income sectors. But most particularly, going forward, if the world is growing less slowly, big companies will struggle to grow. Some small companies will struggle to grow too, but many of those will be able to continue to grow because they're less mature. They'll be able to acquire assets from the receiver, and most particularly make disproportionate returns and cash returns by buying a relatively large business relative to the small market cap, which can be transformational to their returns. So coming back to that, I think the UK economy may not be better than many others, but I think the UK stock market, with its short duration, relatively low beta market, and most particularly its vibrant small quoted company market, leaves the opportunity for the diverse income trust to add value right the way through the investment universe. And most particularly, if we do find that actually the UK starts to outperform the US, it won't be just a fund which has the opportunity to outperform in the UK, but actually could be outperforming relatively to other international stock markets as well.
Okay, great. And maybe you could touch on a couple of holdings that you're excited about in the portfolio.
Yes, it's interesting. And we're still finding, even now, opportunities to invest in new companies which are going to generate surplus cash in the relatively short period. So a good example of that is Mears Group. Mears Group is a business which helps helps housing associations and the council property to repair, leaking ceilings, damp proofing, and all that kind of thing. It's been a difficult period over COVID because many of the routine work they do hasn't been going forward. They've only been doing the emergency work, so volumes have been lower. But as we move beyond COVID, we're expecting that to pick up. In particular, they've been able to keep their service levels really high. They've been able to deal with all of the uncertainties, and they've outperformed their competitors. And so many of their customers, the local authorities, the housing associations, are asking them to do more work. So they can't take on more work. They're actually flat out already. They're expanding nicely, but the valuation is still reflecting the slowdown during COVID. So here's a business which we think is on a overlooked valuation. More importantly, it's generating plenty of cash. But most importantly of all, we think it'll generate plenty of good and growing cash flow over the next 3 years, grow its dividend, and hopefully drive its share price up from what is an overlooked valuation at the moment. So that's one example. Perhaps another example was in a company which we've been following for many years. It's called Lamprell. It's involved in oil rigs. It's a yard which used to make very large numbers of oil rigs in the Middle East. It's obviously had many fewer oil rigs to build over the last 10 years when the oil price has been coming down. But what's been interesting is they've evolved to now do quite a lot of wind farm constructions for offshore wind farms. They've got an attractive order book. They've got a very, very strong prospect book. And actually, with the oil price picking up, they've even seen a few people asking them about building oil rigs again. Anyway, what was interesting is the valuation of the company, which had been over $1 billion market cap in the past when things were going well, had come down to a very low valuation to something just over 100 million, even though the prospects were improving. The only thing which was holding them back was cash. So we were able to help them fund the working capital through an issue of new shares. We think that company could continue to recover and make tens of millions, possibly move back to over 100 million in EBITDA terms, which it made previously in past years. The scale of the opportunity and the recovery of this opportunity and the cash generation which will achieve is just the kind of thing we like getting involved in. And there's another example of things which are just around right now. Amazing.
Great. Yeah, you mentioned the valuation of Mears Group and the scale of the opportunity for Lamprell. I guess looking at the conviction of some of these stocks, you've got maybe a couple of % of the portfolio in these. What would you say to investors who would argue maybe that you should maybe have less stocks and increase your exposure to these companies?
Yes, the portfolio has between 130 and 140 holdings. That's not because we can't make our decision. What we do like is to actually have a range of holdings, so we diversify risk. So the source of income is relatively modest per each holding. And if we do get it wrong, and clearly we must get it wrong sometimes, then it's obviously less downside for our clients. But most particularly, it can mean we can invest in quite small companies. Lamprell is a small company. As I say, its market cap is only just over 100 million. We can't necessarily get a full 1% in that holding. Does that matter? Not a bit of it. If it's got the attractive risk-reward ratio as we think it has, then the holding, we've already got a holding there, which is already coming up to perhaps a 0.3 or 0.4% weighting. But the point is, if it's got the risk-reward ratio and it's got the upside potential, we're happy to invest in those kind of holdings too. So coming back to the question, why don't we have a limited number of holdings? One, because we can invest in small quality companies and participate in the upside. But secondly, to maximize the opportunity to buy and sell. If we need to exit holdings, they're relatively small, we can move on, take the cash out and reallocate to other companies. So it's a combination of both of those reasons, really.
Great. And what's the current cash position in the portfolio? And perhaps you could remind us the trust is trading at a slight premium. But is there, if it did go to a discount, is there a discount control mechanism? How does that work?
Yeah, so the company has between 3 and 4% cash at the moment. We tend to have a little bit of cash ready for all times so that we can just step into the market and take advantage of recent weakness. We put a buy order on to buy a company this morning after the market fell last week. Coming back to the nature of the company, it's an investment trust. One of the problems with investment trusts is sometimes the share price doesn't always reflect the current assets in the portfolio. And so one of the key things about this trust is the board offers on a discretionary basis each year the opportunity to redeem all your shares. That really tends to clear the overhanging sellers, if there are any overhanging sellers. But most particularly, it means that any new buyers know that there aren't any overhanging sellers any longer. So you tend to get more trade, both buyers and sellers in the portfolio, in the trust through the year. So the market liquidity is often relatively good, but most particularly, it means that it does often trade around par, sometimes a slight premium, sometimes a slight discount. It has been trading at a slight premium recently. Most particularly, we think that reflects the fact that actually people are beginning to take an interest in assets which are less correlated with falling bond yields and rising asset valuations. And we feel that this portfolio is well positioned to participate in the recovery of the UK market, or particularly the multi-cap approach in the UK market, should we get a change in pattern in terms of market trends.
Great. And one of the good characteristics about the trust is you've consistently grown the dividend. How key is that? And are there some revenue reserves there that the board could maybe decide to go into at some point if necessary?
Yes, I mean, the trust was set up just over 10 years ago now without any reserves. But over the last 10 years, although it's grown its dividend very successfully over the last 10 years, last year, in the May 2020, the revenue per share did fall as some of the companies did cut their dividends on a one-off basis. Some of them have recovered now, but since that time, the revenue per share has recovered. The board were able to look through that period of setback to not just maintain dividend last year, but actually increase it for shareholders through for the year to May 2020. And we've just gone through the period to May 2021, and the board has actually increased the dividend a little again this year. So what that implies from our point of view is that actually you've got an unbroken dividend record, in part because the board has drawn upon reserves, and in part because they have confidence that the position of the fund is well positioned, hopefully not just to generate some income, but actually some income growth, not over the short term, but over the long term going forward. And that's the key feature, which I think is reflected in that dividend record.
Great, well done, fantastic. Gervais Williams, Head of Equities at Premier Miton, thanks for your time.